Welcome to the description of the content that is going to be covered in week 10. I have planned to cover McKinsey's approach in day 1, John Stewart approach in day 2, BCG approach in day 3, lessons from VBM adapters in day 4, and revision in day 5. McKinsey's approach. McKinsey and Company, which is a leading international consultancy firm, has developed an approach to VBM which has been very well articulated by Tom Copeland, Tim Fowler, and Jack Moran of McKinsey and Company. According to them, properly executed value-based management is an approach to management whereby the company's overall aspirations, analytical techniques, and management processes are all aligned to help the company maximize its value by focusing decision making on the key drivers of value. What is value thinking? To make value happen, companies' actions should be based on a foundation of value thinking, which has two dimensions, value metrics and value mindset. What is value metrics? Does the management understand how companies create value? Does the management know how the stock market values companies? Does the company include opportunity cost of capital in its measurement? Do the metrics reflect economic results or accounting results? Value mindset is how much does the management care about shareholder value creation? Does the CEO strive to seek as much value for shareholders as possible? A management should think in these two aspects, value metrics and value mindset. Which are the areas of activity for making value to happen? According to McKinsey, there are 6 areas where a company must focus to make value happen. Aspirations and targets, portfolio management, organizational design, value driver identification, business performance management, individual performance management are the key activity areas for making value happen. The company must develop a broad statement of purpose that it inspires its employees and specify value-linked quantitative targets which provide some degree of stretch. So the employees will aspire for targets. The company must build a portfolio of businesses which exploits its strategic advantages, improves its performance, and provide portfolio growth avenues. An organizational design with well-developed performance units and individual accountabilities is essential to translate value creation aspirations and strategy into disciplined achievements. A value driver is a performance variable such as customer satisfaction or employee productivity, which has a bearing on the result of the company. The metrics used for measuring value drivers are called key performance indicators. For example, customer retention rates and revenue per employee. Value drivers must be identified, prioritized, and institutionalized into the target and scorecards. Business performance management involves setting targets for performance units and reviewing periodic progress with the objective of enhancing performance. Individual performance management. The thrust of individual performance management is on motivating and rewarding strong individual performance and aligning the interest of managers with those of shareholders. Individual performance management involves setting targets, reviewing performance, and giving appropriate rewards. If the key areas of activities are identified, then it is possible for an organization to create value. Stern-Stewart approach, which is also called as EVA approach, was originally proposed by a consulting firm, Stern-Stewart and Company. This economic value added is currently a very popular idea. Fortune magazine has called it today's hottest financial idea and getting hotter, and management guru Peter Drucker referred to it as a measure of total factor productivity. Many companies across a broad spectrum of industries and across a wide range of countries have joined the EVA bandwagon. What is EVA? It is essentially the surplus left after making an appropriate charge for the capital employed in the business. There are different methods used to calculate EVA which differs from each other, like EVA can be expressed as NOPAT minus WACC multiplied by capital, or it can be expressed as capital into difference in ROIC and weighted average cost of capital. It can also be expressed as PAT minus COE into equity. What causes EVA to increase? EVA will rise if operating efficiency is improved, if value-adding investments are made, if uneconomic activities are curtailed, and if the cost of capital is lowered. In more specific terms, EVA could be increased when the rate of return on invested capital increases because of improvement in operating performance, which means the operating profit increases without infusion of additional capital in the business. Additional capital is invested in projects that earn a rate of return greater than the cost of capital. Capital is withdrawn from activities which earn inadequate returns. The cost of capital is lowered by altering the financing strategy. So these are the different areas where EVA could be increased, and three components of EVA, that is EVA, it is a function of net operating profit after tax, weighted average cost of capital, and capital employed, where NOPAT is defined as profit before interest and taxes into 1 minus tax rate. And this definition of NOPAT is based on two principles: separate the investment and financing side of a firm, which implies that financing charges like interest and dividend should not be considered when we look at profits on the investment side. Financing charges will be reflected in the cost of capital used for discounting the profits or cash flows on the investment side. Do all analysis in post-tax terms and not pre-tax terms. WACC, the providers of capital want to be suitably compensated for investing capital in the firm. WACC will reflect what the investors expect, and the features of WACC should be: it represents a weighted average cost of all sources of finance, it should be calculated in post-tax terms, it should reflect the risk borne by various providers of capital, and hence the formula employed for calculating WACC is cost of equity into proportion of equity in the capital employed plus cost of preference into proportion of preference into capital employed plus pre-tax cost of debt into 1 minus tax rate into proportion of debt in the capital employed. To obtain the capital employed in the business, we have to make adjustments to the accounting balance sheet to derive the economic book value balance sheet. These adjustments are made to reflect the economic value of assets in place rather than the accounting values as determined inherently by conservative historical cost based, which is generally accepted accounting principles. So for measuring NOPLAT and capital, it should be adjusted for distortions of generally accepted accounting principles. As we know, EVA is a function of net operating after tax, capital employed in the business, and weighted average cost of capital. The measurement of NOPAT and capital calls for adjusting for distortions of GAAP. The generally accepted accounting principles have failed to generate accounting reports that reflect economic reality. The gap between GAAP-based accounting information and economic reality stems from the extreme conservatism characterizing accounting practice. Accountants charge off outlays on intangibles like research and development, market development, and employee training. And they follow the principle provide for all possible losses but anticipate no gains. Why are accountants so conservative? Historically, accountants have prepared their statements primarily for the lenders whose perspective is very different from that of owners and managers. As a result, accounting statements provide a portrait for a company from an undertaker's point of view. Securities laws also have contributed to conservatism. Accountants can be sued if they overstate earnings or assets, not if they understate them. Further, regulators have mandated several conservative rules because of a fear that unscrupulous managers may swindle investors by exaggerating earnings and assets. EVA, which is Reliable Guide to Value Creation, to calculate EVA, several adjustments are required to accounting earnings and accounting book value. So the purpose of these adjustments is to derive a NOPAT figure that reflects economic performance and a capital figure that measures the capital contributed by shareholders and lenders. Stone Stewart have identified more than 160 potential adjustments which relate to things like intangible assets, strategic investments, market promotion, goodwill, timing of expense and revenue recognition, and so on. In most real-life situations, however, 10 to 15 adjustments are sufficient. So the most important one that tends to relate are research and development, that is the outlays on R&D are truly investments in future products and processes. Goodwill, under GAAP, goodwill is amortized over a period of time. Under the EVA system, goodwill is regarded as an intangible asset which does not erode in value over time. Perhaps its value will increase over time. Strategic investments, that is normally under the EVA system, the capital charge on an investment is deducted from the time the outlay is made. expense recognition, many companies incur substantial marketing costs to establish brands, enter new markets, expand customer base, and gain market share. Under GAAP, such outlays are normally treated as current period expenses, though they are expected to generate benefits over a long time period. And under EVA system, these outlays are capitalized and amortized over an appropriate period. So depreciation, one of the main considerations that is to be taken into account is often the straight line method of depreciation is used in GAAP, which works reasonably well. But for significant amounts of long-lived assets, the use of straight line method of depreciation is calculating EVA can strongly bias against new investments. Under the EVA system, the capital charge declines as the book value of the assets decrease on account of depreciation. Hence, managers would be reluctant to replace cheap old assets with expensive new assets. How to eliminate the distortion caused by the straight line method of depreciation? One solution is to replace straight line depreciation with sinking fund depreciation, where the annual depreciation under this method is small initially but rises over the life of the asset. It behaves like the principal payment in a mortgage. If the sinking fund method of depreciation is used, the sum of the depreciation charge and the EVA capital charge remains constant over time, exactly like the mortgage payment. Now coming to the restructuring charges, under GAAP, the restructuring charge is treated as a loss on an investment that has turned sold. Such a charge naturally leads to reduction in reported earnings and hence managers tend to postpone restructuring. Under the EVA system, however, a restructuring opportunity is encouraged as it facilitates a more productive deployment of capital. To contrast how restructuring is treated under GAAP and under the EVA system, I will explain it with the case of Apex Limited. How the taxes has to be considered, which are one of the main components of value creation. The companies typically use an accelerated method of depreciation for computing profits for the purpose of taxes and a slower method for shareholder reporting purposes. Hence, the provision for income taxes used in GAAP earnings statement differs from the cash taxes a company actually pays. The book value refers to what a company would owe in taxes if it used GAAP earnings on its tax return, and this difference between book taxes and cash taxes go into a liability account called the deferred taxes, which are presumably payable in future. The problem with this accounting treatment is that most companies never pay their deferred taxes. Even if a company is growing slowly, the depreciation charge on its tax return will push up the deferred tax liability indefinitely, and from an economic point of view, what matters is the tax the company pays now and not what it may pay in future. So, for calculating NOPAT, only cash taxes must be deducted, and deferred tax liability must be treated as quasi-equity and should be included in the shareholders' funds. And coming to the consideration of marketable securities, companies often hold marketable securities, and since these do not represent capital used for generating operating profit, the investment in them should be excluded from the capital employed in the firm. EVA also can be used as the basis for an integrated financial management system. The financial management system refers to financial measures, policies, methods, and procedures that guide the strategy and operations of a firm. It helps in setting financial goals, developing long-term strategic plans and short-term profit plans, making capital investment and disinvestment decisions, measuring operating performance, determining incentive compensation, and communicating with investors. It appears that a typical financial system is hardly a system. The deficiencies call for an entirely different approach to financial management, and the EVA financial management will give an answer and provides a solution for the better financial management system. And the EVA based financial management system is on the premises that it provides a single, unified, and accurate measure of value as well as performance. It links well forward-looking valuation and capital budgeting analysis with actual performance measurement. For these reasons, the more EVA is considered as the right measures for goal setting and business planning, performance evaluation, bonus determination, investor communication, capital budgeting, and valuation. This system serves as an anchor for an internal system of corporate governance that motivates everyone to work cooperatively and enthusiastically to achieve the best attainable performance. So we will discuss various aspects of application of EVA approach to value-based management in our regular classes. And finally, implementing the EVA system involves few steps like developing the top management commitment, customizing the definitions of EVA, identifying EVA centers, analyzing the drivers of EVA, and tailor an incentive compensation system and to train all the employees uh, on the basics of EVA. That is, they must know how EVA is calculated, what EVA means, and how their actions impact on EVA. There are also problems encountered in using EVA, though it has gained immense popularity and which is one of the hottest topics in finance currently. It is considered to be a better measure of performance compared to traditional measures like earnings per share and profit after tax. Many successful firms believe that the use of EVA has sharpened their value-based management programs. Though it has immense popularity, there are certain problems in using EVA, like disincentive for collaborative relationship, imperfect measure, which means to say that EVA is not a perfect measure. It's true, it is a better measure than conventional measures, still it is far from being a perfect measure. Underinvestment. Managers may be reluctant to propose investments that may have a gestation period of few years. During this period, the investment does not produce any returns but has to bear a capital charge, thereby adversely affecting the EVA. And to alleviate with this problem, the underinvestment problem, the firm may use few steps like suspense accounts, deferred compensation, stock options, and value drivers. Also, there are difficulties encountered in divisional performance measures when the EVA approach is considered, then inconsistency with financial reporting. And while evaluating, EVA has been adopted by a number of companies across the globe, though its principal authorities are in the US, while companies like Coca-Cola Procter and Gamble, Godrej Consumer Products. Others have not found it particularly helpful and have even abandoned it. It appears that most of the firms that have implemented it have gained inefficiency, but it is also clear that it is more useful for some types of businesses or situations than it is to others. That is, put differently, it is a useful tool, not a complete solution. It is more appropriate for businesses which rely more on tangible assets and less for businesses which rely more on intangible assets. That is, it is not well suited for financial institutions and for end companies with very uncertain revenues. So I'll be taking an example of EVA-based performance management of few companies like Godrej Group and TCS, and will be explaining this approach to make you understand in a better manner. So we also discuss in this week the approach, one of the approaches to valuation, which is called as BCG approach. So this approach has been developed by an international consulting organization, Boston Consulting Group, which in short is called as BCG, and this is an approach to shareholder value management that builds on the pioneering work of the specialist group Holt Value Associates. The two concepts that are at the foundation of BCG approach are total shareholder return and total business return. So for applying these concepts, two performance metrics are used, that is cash flow return on investment and cash value added. So to take up with total shareholder return, total shareholder return is the rate of return shareholders earn from owning a company's stock over a period of time. And there are several reasons why BCG regards total shareholder return as the most useful measure of value creation. The reasons behind are it is comprehensive as it includes dividends as well as capital gains. It is widely used by the investment community and also required by the Securities Exchange Commission. It can be easily benchmarked against the market or peer groups, and it is not biased by size, and it is difficult to manipulate, and hence the total shareholder return is used by BCG as the most useful measure of value creation. Total business returns is the internal counterpart of total shareholders return. The total shareholder return is what matters to investors. An internal counterpart to it is needed for managerial purposes. For BCG, the total business return is the internal counterpart of the total shareholders return. BCG calculates total business return using a time-fade model which assumes that a firm's return on invested capital and its growth rate will fade over time toward a national average due to competitive pressures. When businesses succeed in achieving above average returns, competitors are attracted by above average returns and try to serve the customer even more effectively. The competitive process tends to force high cash flow to return on investment firms toward the average. Businesses earning CFROIs below the cost of capital are eventually compelled to restructure or downsize in order to earn at least the cost of capital, or eventually they cease operations. Also, BCG uses total business approach for strategic planning, total business return approach for strategic planning, for resource allocation, and incentive compensation. Strategic planning involves choosing strategies and plans that create value. Resource allocation has a critical bearing on value creation in multi-business firms, and a well-founded incentive compensation system aligns the interest of managers with that of shareholders and promotes value creation, and hence the TBR measure can be used for incentive compensation. So the BCG also will deal with CFROI, that is cash flow return on equities, how to calculate the cash flow return on equity, and also return on capital employed and return on gross investment, which is dealt in detail in our regular classes. And also we will discuss about cash value added, which is the key metric that is used by BCG for measuring performance and valuing a company. So finally, I also will discuss and throw light on what are the lessons from the experiences of VPM adopters. A number of companies have joined the VPM bandwagon, particularly in the US. What can we learn from these companies? The lessons that can be learned from the experiences of VPM adopters are top management support and involvement is essential for creating value. A good incentive plan is required, and employees should be properly educated. The reason behind value creation and the choice of value metric is not critical, and VBM works well only in certain cases, and one size doesn't fit all, which I mean to say one approach will not fit all types of organizations. And I also will be concluding by briefing the syllabus from day 1 to the end of the day of completion of the syllabus, and if time permits I will be taking up with the revision classes. Thank you.